Hi there. Today we'll explain how IR35 can affect your self-assessment tax return. Understanding the rules is important for contractors.
Right. Hello everyone and a very warm welcome to The Explainer. If you're a contractor, a freelancer, or you run your own limited company right here in the UK, well, you are in exactly the right place today. We're going to be answering one of the most common and honestly most stressful questions businesses bring to us. What are the implications of IR35 on your self-assessment tax return in the UK? Now, I know it's a topic that literally strikes fear into the hearts of many independent workers, but you know what? It really doesn't have to. Not if you're properly prepared and understand exactly what HMRC is looking for.
Let's actually kick things off with a number that is frankly going to make you sit up and take notice. £20,000. Just picture two IT consultants, right? They're doing the exact same job for the exact same client. Depending on their day rate, £20,000 is the shocking difference in annual take-home pay between the consultant operating inside versus the one operating outside of IR35. And if you get your self-assessment wrong, well, HM Revenue and Customs can slap you with a penalty of up to 100% of the tax due for deliberate errors. So this isn't just a bit of extra year-end paperwork we're talking about, this is your livelihood. It's your business's cash flow, and ultimately, it's your financial peace of mind. I'm your host, a highly experienced UK tax expert, and I am incredibly proud to represent Pro Tax Accountant, or PTA for short. We're your trusted UK accounting firm, entirely dedicated to helping businesses like yours master these seriously complex tax rules. We've seen firsthand how simple, honest misunderstandings around IR35 can lead to absolutely devastating tax bills, and we're here to provide definitive tax clarity. The goal is simple. Let us handle the tax headaches so you can focus on what you actually do best, running and growing your business. Okay, let's dive into this. Here's our roadmap for today. We're going to cover the current rules, who they affect, the steps for compliance, calculating the deemed payment, mistakes to avoid, and wrap up with how to get expert help.
Section 1. Let's take a look at the current rules and stats surrounding IR35. So the core of IR35 is entirely binary. It's black and white. You're either inside or you're outside. But what does that actually mean for your pocket at the end of the month? Well, if you are inside IR35, HMRC basically views you as a disguised employee. For tax purposes, you're treated just like regular staff. That means your income is subject to full PAYE income tax and national insurance contributions, which, as we know, drastically reduces your net pay. On the flip side, if you're outside IR35, you're operating as a genuine, independent business. You pay corporation tax on your profits, and you have the full autonomy to extract your income tax efficiently, usually through a strategic mix of salary and dividends.
Now, the rules are shifting rapidly, and you really need to be aware of this. To be classed as a small company, a business has to meet 2 of 3 criteria. Look at these changes. From April 2025, the turnover threshold jumps from £10.2 million all the way up to £15 million, and the balance sheet threshold rises from £5.1 million to £7.5 million. This is a massive, massive change for the contractor market. Why? Because company size strictly dictates who actually assesses your tax status and who ends up carrying the financial risk.
Time for a quick insight segment. Did you know that because of these upcoming threshold increases, approximately 14,000 businesses are going to be reclassified as small? For you as a contractor, this means the compliance burden and the severe financial liability that comes with it shifts right back onto your personal service company, your PSC. You are going to be the one solely responsible for determining your tax status, keeping the audit trail safe, and ensuring you pay the correct tax on your self-assessment. No pressure, right?
Which brings us perfectly to Section 2. Who exactly does IR35 affect in the real world?
Honestly, the legislation impacts almost everyone in the labor supply chain. Contractors operating via a PSC, well, you're always right at the center of it. Now, if your end client is a medium or large business, they hold the legal responsibility for assessing your status and bearing the risk. However, like we just touched on, if your client is a small private sector business or based wholly overseas, they are entirely exempt from assessing. That leaves the full burden squarely on your shoulders. And let's not forget the recruitment agencies. Agencies are quite often caught in the middle, acting as the fee payer. They end up carrying the tax risk and must operate PAYE if the end client happens to get the assessment wrong. It's like a giant puzzle.
Now, when a medium or large client does assess you, they absolutely must issue what's called a Status Determination Statement, or SDS. This is a formal document that officially declares whether you are inside or outside IR35. And crucially, it has to give the detailed reasons why they made that decision. Here's something a lot of people don't know. If you receive an inside IR35 SDS that you strongly believe is just wrong based on your actual working practices, you have the legal right to challenge it. You do this via a client-led disagreement process, and the client is legally bound to review your challenge and respond within 45 days. Don't just accept it if it's wrong.
Moving on to Section 3. Let's look at the actual steps for IR35 compliance.
You see, HMRC doesn't just look at the contract. They look closely at the reality of your working day. Do your daily practices match the written word? The big 3 tests are absolutely crucial here. First up, control. Does the client dictate your hours and methods? Like, are they making you log into their specific software at 9 a.m. sharp, or do you just deliver a project your own way? Second, substitution. If you fall ill, can you genuinely send another qualified contractor in your place, or do they only want you specifically? Third is mutuality of obligation, or MOO. Do they expect you to stick around for the next project when this one ends, and do you feel obliged to say yes? Also, little things like providing your own high-end equipment rather than using a company laptop and taking on real financial risk, like having to fix your own mistakes at your own expense, these strongly point towards you being a genuine business outside IR35.
Now, what's really interesting about this next slide is how we actually do the maths. Let's look at calculating the deemed payment.
If you're caught inside IR35 by a small or overseas client, and it's up to you to run the calculation on your self-assessment, it is a very strict 6-step process at year-end. Let's just imagine you have a $100,000 contract. Okay. Step 1, you take that income and deduct a flat 5% for running costs. But listen carefully. This 5% allowance is only available if your client is small or overseas. In Step 2, you add any direct benefits you received. For Step 3, you deduct allowable employment expenses, followed by Step 4, where you deduct capital allowances and pension contributions. Moving to Step 5, you strip out any salary and NICs you've already paid yourself. And finally, in Step 6, you calculate and deduct employer national insurance on whatever is left. That remaining balance? That is your deemed payment, and that must be subjected to full PAYE and declared on your self-assessment.
Okay, time for a massive professional tip from us here at PTA. When you are filling out your self-assessment tax return, specifically the SA-102 employment page, you absolutely must report this deemed employment payment. But crucially, you need to ensure Box 8 is marked with an X. It seems so minor, right? But if you miss this tiny detail, you run a very high risk of HMRC's automated system taxing you twice on the exact same income. It is literally a total nightmare to unravel, so don't forget the X in Box 8.
Section 5. What other traps are out there? Let's talk about mistakes to avoid.
You've got to remember, HMRC's automated systems are incredibly sophisticated these days. Common errors that trigger immediate audits include treating your business account like a personal wallet, buying your weekly groceries on the exact same card you use to buy your server hosting. Keep them strictly separate. Also, failing to declare small bits of incidental income, like just a few pounds of savings interest, will get flagged instantly, because the banks report this directly to HMRC anyway. Furthermore, please never rely on rough estimates. It was about 500 quid, just isn't good enough. HMRC expects exact, provable figures down to the absolute penny. Ensure your unique taxpayer reference, your UTR, is correct, and above all else, do not miss the 31st of January online filing deadline. Missing it triggers an automated £100 fine literally on day 1, and they continually add daily interest to any unpaid tax.
Here's another quick Did You Know insight for you, and this one is a highly valuable recent update. If you happen to have a student loan and you're operating inside IR35, your benefits in kind, think things like private health insurance that are processed through payroll, they actually used to artificially inflate your student loan repayment calculations. It was costing contractors significantly more per month. But from the 24-25 tax year onwards, a brand new box 1.1 on the SA-102, allows you to separate these out. This stops you from overpaying your student loan. It's just a small detail on the form, but it saves serious cash.
Okay, navigating IR35 and self-assessment is clearly a bit of a minefield. So, let's move to Section 6 for our summary and how to get some expert help.
So the crucial point is this. You absolutely must isolate your deemed inside IR35 income properly on your SA-102 to avoid that dreaded double taxation we talked about. You also need to maintain a strict 5-year audit trail of your contracts and, more importantly, proof of your actual working practices. Keep those emails, keep the project briefs, everything.
You can definitely use HMRC's Check Employment Status for Tax or CES tool, but please treat it very cautiously. Use it as a starting point, not the final word, because it often really struggles with complex real-world cases. And finally, never ever just accept an incorrect status determination statement from a client. Challenge it if your daily working practices prove you're a genuine independent business.
Look, you really don't have to tackle this whole shebang alone. At ProTax Accountant, we deal with IR35 and incredibly complex self-assessments every single day. Protecting contractors is what we do. So grab a pen, call us directly on 0798-568-9912, or drop us an email at info@protaxaccountant.co.uk. You can also visit our website at www.protaxaccountant.co.uk to book a consultation. Oh, and if you found this explainer valuable, make sure to hit that subscribe button on the PTA YouTube channel right now for more expert tax strategies and updates.
Before we completely wrap up, just a very quick note. This explainer is for informational purposes only and does not constitute formal financial advice. As we've seen, tax law is highly specific to the individual, and your personal risk profile is completely unique to you. Always consult a professional tax advisor regarding your specific IR35 and self-assessment circumstances. PTA accepts no responsibility for loss.
All right, I'm going to leave you with one final thought to ponder today. Have a good look at your current engagements right now. Is your contract truly outside IR35, or are your actual daily working practices quietly leaving you exposed to a potentially devastating HMRC inquiry? Don't just cross your fingers and leave it to chance. Get in touch with us at PTA and let's secure your tax position today. Thank you so much for joining me, and we'll see you in the next explainer.